Hey everybody, it's Mark Pruitt with Strategic Estate Planning Services for another market update. Appreciate you being with us today. A lot going on in the world. I'm not going to rehash all of it because I'm sure you're keeping up with a lot of it. But I want you to know how all of that can affect you and your portfolios, and to try to give you a little bit of a forecast of potentially what we may see that is coming. So first off, let's tackle inflation. You look at inflation. It just came in at 7.9 for February. So if you do a quick history, you look all the way back to October. October, it was at 6%. November, it was at 6.5. In December, it was at 7. In January, 7.5. February is now 7.9. So when you look at that, that is continuing to rise with inflation, and we are expecting March to actually be higher than that. So you take that and you go, okay, the Fed, we should expect the Fed to begin to raise rates. We're expecting this in March. Anytime that should be happening. The question now is going to be, with Russia involved, is how fast are they going to go? Because that may, with the war in there, that changes the dynamics all over the place. So when you look at the next thing that you're going to begin to hear on the news, it's a word we don't hear that often, but if you're old enough, you've heard it before and you've been in it before, and that is the word recession. That is a very strong possibility. We are expecting, I am expecting, and you just look at it and see just from common sense that says the GDP is beginning to weigh in this first quarter. We already said it was going to be tightening. We've told you that, and we told you that back in November it was going to start happening. The war has just sped that up even more so. With gas prices getting higher, groceries getting higher, things like that that begin to cost more and more and more, what that happens is there becomes a GDP downturn. And I'm expecting by the end of this first quarter for GDP to either be negative or to be flat. But I can tell you either one of those, it has gone down from where it was in the fourth quarter of last year. And so this is important to know in regards to how recessions are measured. You know, a recession is a macroeconomic term where it looks at a lot of different things, and it refers to a significant decline in a general economy or economic activity for a specific area or region. For us, it would be all the way across the United States. So when you look at that, the old version is 2 quarters of GDP downturn. That was how they many times they referred to, once you have 2 GDP quarters that are down, and then you're going to be into a recession. Well, however, take a note of this, the National Bureau of Economic Research, called the NBER, they are the ones that officially declare recessions. And basically, when they say 2 consecutive quarters of a decline in real GDP, that's really not how it's defined anymore. And so they have redefined it. And what that is, they define a recession now as a significant decline in economic activity spread across the economy as a whole, lasting for more than a few months. Few months is usually 3 or more. If not, they would say 1 or 2. So few. And normally when you get into that, that is visible in real GDP. So they're specifically defining that on GDP. They're also defining it on real income. They're defining it on employment, industrial production, wholesale and retail sales. That is their new version of how they are defining a recession. And so key takeaway, let me repeat it. A recession is a period of declining economic performance across the entire economy that lasts for several months. My thought process is that's what we're going to begin to see. We saw this in February already. We've seen it in March, and we actually started seeing it in part of January as well. And a lot of that is driven based on the prices of everything. So people begin to watch their dollars closer. And as they watch their dollars closer, and they're spending more on gas and food, basics, They put off other things that they were going to do, like maybe we were going to remodel, or maybe we were going to build a house, or maybe we were going to take a trip, and now we're not going to do that. We're going to rethink that. And that makes the economy as a whole, when a bunch of people do that across the nation, that GDP begins to contract. And so that's the thing you probably need to be aware of next as far as recession. Very, very important. The other thing I want you to be aware of is we are continually still tweaking portfolios, 2% more into energy as an example, or into gold, or into certain type of bonds. And we're still staying in some securities because we've got to be able to see that turn. But you can tell if you look up on yahoo.com, you can look up the Dow, you can look up the NASDAQ, you can look up the S&P, you can look up the Russell 2000, and Google it, Russell 2000 chart, S&P 500 chart, and you can go year to date, and you can see that your account is not mirroring that loss unless you are very young and you are in aggressive growth and you have a lot of time in your life. But if you're retired or nearing retirement, we worked very hard to make sure that we're not mirroring that market, because we don't want a swift downturn in the market to wipe out what you got right before you need it or in the middle of retirement. So make sure if you're going to measure that you're measuring that way. If you've got questions on that, obviously, feel free to give us a call. We'd be more than happy to talk with you about your account specifically. And I'll also tell you, when I look at not the entire account, I'm not just looking at your securities. I actually look at the annuities as well. If you have annuities or you have insurance, life insurance, or things that are fixed instruments of any kind, make sure you keep that in mind, as far as it's not just one thing, but it's all of it combined. But yet we're really trying to manage, because I don't have to worry about stuff that's fixed. I don't have to manage that. What we're trying to manage is the stuff and to make that not mirror the market as much as we possibly can. So we feel like that's happening right now. It's working well, but there's still more to come, we feel. And so that management's going to continue, and the tweaks will continue as well. Make sure that you're being careful in how you spend, where you go. And I'm actually getting those calls of, should I do this, or should I take this trip, or should I, what are your thoughts are? And your gut probably is your best feeling in the beginning. Is if you're not sure, pause. Doesn't mean you're not going to do it. It means it's a pause right now. So a year from now, hopefully some things will be changed and we'll be out of some of these patterns that we're in now. Right now, just kind of hold on tight. Again, if you've got any questions at all, give us a call. We're more than happy to talk with you. 1-800-381-8870. Thank you, guys. Appreciate your trust in us. God bless you, and have a great rest.